Happy Tuesday, May 5th. Welcome to another exciting edition of Rate Desk. I am your host, Michael Thomas, here to report about things in the multifamily markets. Jumping into the big stock exchange markets. All the major indices are up. Hey, that's good news. More good news. Crude oil futures, they broke 25 a barrel. Hey, that's great. Wasn't I just saying they broke 20 a barrel yesterday? Now they broke 25. That's great. Good trend. Nice to see. We are seeing an uptick in the U.S. Treasury yields. The 10-year yields are up just 0.02, trading around 66 basis points. Last time I checked, we are seeing pretty similar permanent rates. On the 223F, we're looking at 2.60 fixed for 35 years. And on the 221 D4, we're looking at 3.25 fixed for 40 years. Jumping over to the agency side. So yesterday we talked about the 10-year Fannie Mae at 320. Remember, agency loans really live off of exceptions. If you want better pricing, you've got different ways to get there. So lower leverage, 55 to 65%, size of the market, and on and on and on. So recently there was a deal, 6-property portfolio deal that was locked in the 270 range. Very attractive pricing. I'd say without some of the lower leverage exceptions, might be looking at a price of 310 to 315 today on Fannie Mae, which is better than it was before. So we're seeing a little downtick there in the quoting on the Fannie Mae desk. Jumping over to Freddie Mac, no changes there. 340, 10-year fixed, same old on the Freddie Mac. Jumping over to conversation I want to have with you regarding HUD loans. So we had talked about in a previous episode, if you recall, that it's very important for you to track your move-outs, why they're moving out, and anything that you see as a disruption to your property related to COVID-19. Also, talk to your property manager and report your policies and procedures. What are you doing? Obviously, the social distancing. How are you complying with the local orders? All of those things are also very important. In addition to that, the good news is HUD is not requiring a brand new appraisal or a brand new market study if they haven't expired just because of questions related to COVID. That's good news. However, they are asking for some additional information. They're asking for some economic projections, some future sort of looking trends, and they're looking at, can we compare this to any prior periods in history and what those impacts might look like, and going forward, what this might look like. In other words, HUD is asking for some extra credit homework, is what I would call it, from the market analysts and from the appraisers, so that we have a more of a sense or of a grasp moving forward. What are some of the impacts to multifamily housing in your primary market area? That's the most important thing there. In general, I think the trends are looking good. April was pretty strong. It wasn't much difference there. We're seeing a lot of stabilized properties. We'll see when May numbers get published what those look like, but folks have got to live somewhere. Hey, some analysts are predicting, and this is good news for us in the multifamily space, that rental housing is going to grow at a higher rate post, lifting all these stay-at-home orders. So I want to find that report and read if there's any reason or rationale behind why they think that, but I think that's interesting, and it's certainly a positive note to end today's episode on. So we will finish off Tuesday with that. Thank you for tuning in, and I look forward to seeing you again. Come back to see me at Rate Desk. This is Michael Thomas, signing off.